Welcome back. In today's video, I'm going to talk about the non-registered investment account. These are sometimes called a taxable investment account. Some examples of registered accounts that you may be familiar with are the RRSP, the TFSA, the FHSA, the RESP, the RDSP. There are several of them, but those are the main ones, and I've got a video on most of those. And if you watched my videos on some of those, you'll know that there's several tax advantages to opening those accounts. But with those advantages come a lot of restrictions on those accounts as well. And one of the big advantages of a non-registered investment account is that those restrictions are gone. So first, you do have to be 18 or 19 depending on your province. So that's one restriction. But there are no restrictions on how much you can contribute to the account. There's no restrictions on when you have to withdraw from the account. There's no restrictions on how much you can withdraw from the account. There's no restrictions on an age limit when you have to stop investing into account. And these are all restrictions that those registered accounts did have and have been taken away with this account. So really, with the non-registered investment account, you could be 100 years old, put in $1 million one day, take $1 million out in that same day, and then put that $1 million back the very same day. I don't know why you would want to do that, but you can do that, and you can't do that with any registered accounts. The big disadvantage to a non-registered account is that every time you sell a security, you will be forced to pay tax on that security. So a security could be an ETF, a stock, a bond, whatever you happen to hold in that non-registered investment account. You also get taxed on the dividends or the distributions that get added to your account each year. But what people don't realize is that these accounts are actually taxed quite favorably. In fact, a lot more favorably than your savings account that you might have or your income tax as well. So how are they taxed? Well, for a non-registered investment account, there are two things that are going on and going to be taxed differently. One is your distributions or your dividends. And basically what a dividend is when a company gives you money just for owning that share. So for example, here you can see if you owned, let's say 100 shares of Royal Bank here in Canada, and they pay out at the time of this recording $1.38 Canadian per share every quarter. So that means if you own those 100 shares of RBC stock, then every 3 months you would get $138 deposited into your account just for owning RBC. That's a very simplistic way of looking at dividends, and I'll have a separate video looking at dividends. Now, dividends are taxed favorably if you hold Canadian companies in your non-registered investment account. The actual complication to it is fairly complicated. There's some gross up that gets added to your income and all that sort of stuff. But for the sake of this video, I'm not going to get too deep into it. All you need to know is that Canadian companies do get taxed very favorably. So if you held RBC in your non-registered investment account, you can see here on the first $55,000, you would get taxed at 2.57%. After that, 10.16%. There's a huge tax advantage for holding Canadian companies in your non-registered investment account that pay dividends. The second thing that gets taxed is your capital gains. Now, what is a capital gain? Capital gains are just basically the amount that your investment has grown. So let's say, for example, again, let's stick with RBC. If you bought $2,000 worth of Royal Bank stock and it grew to $3,000, that means your capital gain is $1,000. That $2,000 grew $1,000 to turn into $3,000, so your capital gain is $1,000. Now again, one important thing to note is that you won't get taxed on that unless you sell. So once you sell those shares of, again, Royal Bank, then you will be forced to pay tax on that during tax season. The other important thing to note is that only 50% of your capital gains gets taxed. This is great. This is huge. This is a really good tax advantage to holding investments in your non-registered account. So again, using our earlier example of $2,000 worth of RBC growing to $3,000, we had a capital gain of $1,000, and only 50% of that gets taxed. So that means $500 gets taxed at my marginal tax rate. So here in Alberta, I've got the tax rates here. I'm in the 30.5% tax bracket here. And so that $500 would get taxed at 30.5%, and I would owe $152.50 on that capital gain. So the growth from $2,000 to $3,000, essentially I would only get taxed $152.50 on that, which you can see is a tax rate of 15.25% on the capital gains, which is better than the 30.5% that my income is getting taxed at. There was a big announcement in the new federal budget recently, and starting June 25th, 2024, if you sell any investments that has a capital gain of more than $250,000, then the first $250,000, you'll be paying tax on 50%, but anything above $250,000, you're going to be paying tax on 2/3 of it. So 66.7% of it will be taxed. There were other rules regarding small business owners and corporate accounts. I'm not going to get into those capital gains. For the sake of this video, I'm going to stick with the non-registered investment account, and those were the new rules. So for example, let's say you had a $200,000 portfolio that grew to $600,000. So that has a capital gain of $400,000. The first $250,000, 50% will be taxed, so $125,000 will be taxed. And then after that, the remaining $150,000, 2/3 of it will be taxed, so an extra $100,000. So in total, $225,000 of your capital gains will be taxed instead of the original $200,000, which was the rule prior to this new phase. Essentially, that works out to 56.25% of your investments being taxed in this case if you had a capital gain of $400,000. I don't think this in particular will affect too many of us. Honestly, if you had that much in capital gains, you could break it up. You could sell $250,000 worth of capital gains one year, still fit the criteria for 50%, and then the following year, just pull out the rest and you'd still be in that 50%. It used to be really important to keep track of your ACB, your adjusted cost base, basically keeping track of your capital gains, but your brokerage will now have good records on all of that. And during tax season in February to April sometime, you will be receiving a T5 or T3 depending on the account type, and it'll tell you exactly how much you owe in dividend taxes and how much you owe in capital gains taxes. So that's all done for you, and it's fairly straightforward. Now, what happens if your security loses money? Well, the great thing about this account is that you can actually claim a capital loss on that. So again, if you had $2,000 worth of Royal Bank and it went down to $1,000, so now I've lost $1,000 of my investment. If I sell that, I can keep that capital loss of $1,000 and I can use it to offset a future capital gain. So you'll often hear of tax loss harvesting during a bad year. So if during a year markets go down 20% or 10% or whatever it happens to be, you'll see a lot of people selling investments from their non-registered accounts so they can claim that capital loss so they can offset a capital gain later on. An important rule to note there is that if I, again, hold RBC in my account and it has a capital loss of $1,000, I can't just sell it on December 1st, claim the capital loss, and then rebuy it on December 2nd. You actually have to not purchase that same security for 30 days. But what's interesting is if you're an index investor, let's say you hold shares of XIC for your Canada portion, your TSX portion, then you could sell that, claim the capital loss, and then the very next hour buy ZCN, just a different companies. You hold all the same stocks, all the same, it's the same portfolio from a different company, and that doesn't count against the rules. That is totally okay. So these non-registered investment accounts have several advantages, and they can be quite useful, especially if you've maxed out your TFSAs or your RRSPs and all that. It could be your next step in your investment. If you've enjoyed this video and would like to stay informed of some of my others, please subscribe below. And as always, have a wonderful day.